Well, we are now entering both a new month and new quarter for the markets. Before we do that, let's recap how things played out in the stretch that just ended. As we right now look at the intraday charts, there's a look at the TSX year to date. So let's walk through what's been happening over the course of the year. We had already mentioned that we just came off the second worst monthly performance of 2023 in September. August was also a down month, although given that July was positive, when you put it together, the third quarter loss ended up being about 3%. Most sectors did struggle. One that did not, of course, energy, with oil prices climbing north of $90 and going from around 70 to 90 over the past 3 months. As for the U.S. market story, the S&P is coming off its worst month of the year with that notable pullback in tech stocks, which have a greater market influence stateside than they do in Canada. And so the quarterly decline was larger than in Toronto, but that tech influence has helped the year overall still look pretty good in New York. The S&P holding on to a double-digit percentage gain. Actually, history also suggests that when you have the kind of start to the year that we saw, followed by some weakness in August and September, it's actually not surprising to see things pick up again in the final months of the year. Outside of all the economic and political variables on the table right now, it is worth noting that after an earnings recession, the profit picture is expected to improve, particularly as we head into the fourth quarter. So let's get some perspective on year-end positioning from our next guest. Kevin Headland is co-chief investment strategist at Manulife Investment Management. Kevin, thanks very much for your time today.
Thanks for having me.
So I just wanted to do that scorecard because we're entering this home stretch. There's a lot of big headline stories, and yet a lot of those headline stories haven't really changed over the course of the year. It's just the interpretation of where we are in that storyline, which I think investors are trying to get their heads around. What's your assessment right now?
I think right now we're about exhaustion over what the Fed is going to do and when are they going to hit the peak rates. But not only that is when the cuts are going to start. And I think right now the market is kind of a little jittery, the fact that perhaps the Fed is in the soft landing camp. They're going to slowly reduce rates over the next couple of years and probably not start till the back half of next year. I think that's where the market's been priced for perfection, shall we say, meaning that anything positive is what is expected, meaning perhaps a faster rate cuts, the soft landing narrative, perhaps better earnings, and anything that we don't get, any negative impacts, we've seen some of the choppiness and volatility in the markets, which is what we've seen since, called July of this year.
Yeah, well, let's dive into it, because we already had a guest this morning who thinks a recession is inevitable for North America. So he's talking about Canada and the United States. And I guess we're going to have to see how central banks feel about sticking with higher interest rates if we're in a recessionary period. I mean, what's your expectation?
That is our base case as well, recession, both U.S. and Canada. Perhaps Canada a little bit deeper and longer lived, shall we say, than the U.S., mostly because of the over-leverage of the Canadian consumer than the U.S. But I think it'll be interesting to see how quickly the central banks react to weaker economic data. We've had a lot of upside surprise so far this year, especially out of the U.S. How willing and how fast will the central banks move in anticipation of weaker economic growth if inflation is still in that 4% level?
Yeah. Are you anticipating that what are you anticipating they'll do?
I think the Bank of Canada will move perhaps a little quicker. I think giving that, helping out that Canadian consumer a little bit early on, because that will help alleviate some of the downside risk. Whereas the Federal Reserve may be a little bit slower to react. They don't want to repeat some of the errors in the early 80s. Inflation remains their target, but at the same time, we likely believe they are going to start cutting rates sooner and faster than currently is expected by both the market and the Federal Reserve's dot plots.
All right, so you're absolutely right. This is what the market seems to be obsessed with. Sometimes we get a little bit tired of it because it's been going for so long at this point. But how are you positioning? What's your investment philosophy at this point with all this stuff in the air right now?
So right now, from an equity perspective, we've been saying prepare for near-term volatility amidst that uncertainty. Of course, we had one of those uncertainties kick down the road a little bit with the government shutdown in the U.S., but there still is a lot of uncertainty out there, perhaps weaker earnings going through Q3 and Q4 and into next year, perhaps U.S. recession. So perhaps taking a little bit of that profit off the table right now, maybe readjusting to higher quality stocks, looking at other companies within the S&P 500 that have perhaps not performed as well this year as the top 10 names, as they've been driving the S&P 500. But I think also we want to just kind of reduce some of that equity volatility, embrace some fixed income, where we think fixed income right now is still a really attractive environment, despite what we haven't seen this year so far is a bit of weakness given the higher yields.
I guess the one question that seems to come up with fixed income is, what if the rates stay higher, or what if they have to go higher? And could that expose you to a little more selling pressure in bonds if you were to step in right now. But the yields look good enough to you that it's a trade-off worth making?
It's definitely really a great trade-off right now, I think, for us. And it's really where you're going to be investing in fixed income. I think there's got to be a lot of flexibility in fixed income. It's not a short duration or long duration play. It's about being flexible, embracing the investment-grade credit right now where yields are extremely attractive and prices are on average sub $90. So that's also not just yield, but also potential capital gains in that marketplace.
You talked about quality with stocks, if people are going to stick with equities. What does that mean to you? Is it a sector that represents it? Is it a makeup of a business that makes it a quality play?
Right now, I think it's a makeup of business. We've seen so far this year is earnings have been on general negative, but a lot of companies have beat expectations. That's really a lot about cost cutting. I think the next level is really about that cash flow generation. Can they beat on the top line, not just on cost cutting? So it'll be really not just about the beat of earnings, but how they beat. They'll really be driving the potential quality businesses going forward.
And would you be looking for companies that have experience in doing that when the economy is slowing?
Definitely. We're going to look for companies that have proven that over time, have dominant place in their marketplace, those that are really generating the top line revenue growth throughout cycles. It's not necessarily going to be an exciting time. Those companies should be rewarded more than other companies in the marketplace.
Okay, Kevin.